Chapter 10, Making Capital Investment Decisions. In the previous chapter, which was chapter 9 in this class, we looked at four very different ways to figure out if an investment opportunity is worth it or not worth it. We looked at the net present value technique, the profitability index technique, the payback period technique, and the internal rate of return technique. And from those four methods, we saw how they all have some advantages and disadvantages. But the net present value approach was by far, the most accurate one in identifying if a project should be accepted or rejected. And so what we are going to be doing in this chapter is focusing more on the net present value approach to evaluating an investment. So just to remind you again, in the net present value approach, we consider the cash flows that would take place if the project is accepted. Right away, we would need to spend a lot of money. That's a typical investment project. The cash flow in year 0 or today is called the initial cost. And then in the years that follow, we would be receiving profits. And we call them cash flow in year 1, cash flow in year 2, in year 3, and so on. So until now, all these numbers, all these future cash flows, as well as the initial cost, have been given to us, right? We were given dollar amounts, which we would be then putting into our financial calculators, cash flow keys, to find the NPV. They're no longer going to be given to us. We will learn how we actually calculate them. And to give an idea of what will be going on in this chapter, maybe there will be, let's say, 10, 15 relevant pieces of information, relevant cash flows given to us for every year of a project. And we would need to know which formula to use in order to put them together correctly to give us that one final cash flow for each year, which sort of summarizes all the available information that's given to us for that year. So because we will be working with a lot of information for the year when the project will begin and all the way through the final year of the project, we need to first know how to identify what's relevant and what's irrelevant. Irrelevant means we can ignore those dollar amounts. We can cross them out. They are not going to be used in our net present value calculations. So here I have a few examples. Taxes, lost revenues from existing projects, wages to employees, depreciation expense, money paid to consultants, initial purchase price, interest payments on debt. So these are not, the only type of cash flows we will be working with. This is just an example, like a small set of all the information for a project. Turns out some of these are actually called irrelevant to project valuation, which means we don't need to worry about them. We can cross them out and forget about them. We will not use them in our NPV calculations. So which are relevant and which are irrelevant? That's the topic on the next couple of slides. Taxes, they are very important. We must pay taxes on our corporate income. Wages to employees, without employing people, we will not be able to produce the product that we are planning to sell, in this project. Lost revenues from existing projects, well, if by implementing some new project, we are going to see lost sales from something else we already have, that's an important, consideration, right? So this is also a relevant type cash flow. Depreciation, initial purchase price, interest payments on debt, money paid to consultants. So let me just speed it up a little bit and say that among these 1, 2, 3, 4, 5, 6, 7 examples, there are 2 which are irrelevant. And these 2 are money paid to consultants and interest payments on debt. It might look strange why this would be unimportant. So money paid to consultants, paid, right? This verb is in the past. This is the money that has already been paid before we are making our decision to accept or reject the project, right? So it's not like if we decide to reject this project because the NPV is negative, we would then come back to our consultants that we were working on some, maybe market analysis related to this project and ask them to pay us the money back, right? This money will not be recovered anymore, whether the project is accepted or rejected. And because it already occurred in the past and cannot be recovered, we call it a sunk cost. So money paid to consultants is an example of what we call a sunk cost. And sunk costs are irrelevant to project valuation. So if there is something that looks like money that has already been spent in the past before the decision on the project is made, then you should cross that number out from your list, and you will not be using it anywhere in your net present value calculations. Now, why are interest payments on debt also considered irrelevant? I would say there are a couple of ways to explain it. First, interest payments on debt are financing expenses. They are not so-called operating expenses, which are necessary to produce the product. Interest payments on debt, like making payments on a loan, right? And maybe we took a loan to cover part of the initial cost, like buying any sort of furniture or equipment or buildings, right? So why are interest payments considered irrelevant? Another reason is, other than being sort of a different category of cash flows, not operating but financing, you can also say that taking a loan is kind of an optional thing. If the company had money, it would not need to take a loan, right? And in that case, what would the cash flows that are, really required for the project, and exclude any sort of interest payments that are kind of not very necessary? What would the cash flows then tell us about the acceptability of this project? So interest payments on debt and the money that has already been paid, like paid to consultants or maybe research and development, are the 2 cash flows that we are going to treat as irrelevant to project valuation. Another way you can explain what relevance refers to is, you can say that relevant cash flows are incremental cash flows. The word incremental means additional. Additional to what? Additional to a firm's existing cash flows, right? So incremental or relevant cash flows are cash flows that are incremental to a firm's existing cash flows, right? On other projects that it already has running, and that are a direct consequence of taking this project. You can also say that incremental cash flows will only occur if the project is accepted. Incremental cash flows should be included in a capital budgeting analysis. In other words, in calculating the net present value for some investment opportunity. There's also another, little topic that's related to cash flows being relevant or not, called the stand-alone principle. What this means is we need to be analyzing each project in isolation from the firm simply by focusing on these incremental cash flows. In other words, imagine we have a restaurant chain. It currently has 10 restaurants, right? And it's now considering whether it should open one more restaurant in the area, the 11th one. So rather than calculating the net present value from all future, cash flows coming from all 11 restaurants and comparing that to the net present value coming from, revenues from the current 10 restaurants, we should instead look at the 11th restaurant only, kind of isolated from everything else, unless of course it has some impact on our existing restaurants. So maybe by opening the 11th restaurant, we are going to lose some sales from another restaurant that's close, the closest to it, something that also belongs to us, right? Then the 11th restaurant has, this negative impact on the sales from one of our currently operating restaurants, and that part would need to be considered. Okay, so in this table here, I kind of try to summarize, different terms used for different types of cash flows. The first two rows include sunk costs and financing costs. And these are the two cash flows that I put no for in the last column in this table. No means not relevant, right? So sunk costs are those expenses that have already occurred. They're not recoverable even if the project is rejected. An example includes money paid to a consulting firm to do some sort of preliminary, maybe data collection, data gathering and analysis, research and development, R&D, and so on. Then second, financing costs, also treated as irrelevant. That's essentially anything related to taking a loan and paying back to the lender. So interest expenses. We are going to ignore them. Right, so if we decided to take a loan or sell bonds to borrow money for our new project, then these are the kind of numbers that would be ignored in our net present value calculation. Then I have side effects, also known as spillover effects or project externalities. There are two types of side effects. A negative effect on a firm's existing product is called erosion. A positive effect on a firm's existing project or product is called synergy. Let me give an example. So let's say 10 years ago, roughly, when Apple was, considering selling iPhones for the first time, right? I'm pretty sure Apple was realizing that when iPhones would start selling, iPod sales would drop, right? So there would be less money coming in from selling iPods, which was Apple's existing product. This is an example of erosion. On the other hand, Apple was probably realizing that if iPhones become a big hit, then people who love iPhones might start spending more money on buying other Apple products, like paying for songs on iTunes, buying Mac computers, and other Apple products. This is an example of the so-called synergy effect. And both the erosion and the synergy, cash flows are relevant to project calculation. In this chapter, we're actually never going to look at any numerical problems which have something so complicated going on, like the whole erosion or synergy. But it's just, so at least I won't have them on my slides. Maybe in the homework, a little example, but nothing like a full-blown net present value over multiple years, nothing of that scale. Opportunity costs are also relevant. It means foregone revenues from an alternative project. So maybe we are currently considering converting a parking lot into an office building. That's our project for which we are trying to calculate the net present value. But an alternative to that would be selling the lot and making some money. So the money that we could have instead received from selling this parking lot should be included, when we are calculating the sort of overall kind of the net initial investment into, this office building project. Net working capital, NWC, is another type of relevant cash flows. By definition, net working capital equals current assets minus current liabilities. Current assets include things like cash or other more or less small items that can be converted into cash quickly and easily, such as inventory and accounts receivable. Current liabilities include short-term loans. Short-term means needs to be paid back within 1 year. And current liabilities also include accounts payable. So the money that a firm owes to its suppliers, again within maybe a few weeks or a few months. So net working capital, as related to the whole funding the net present value for a new project, includes examples like maybe right away, if we decide to launch this project, we would need to set aside a few $100s in cash, right? Or maybe we would need to buy inventory or do something with accounts payable or accounts receivable. But just think about cash only. It's sort of the easiest thing to explain. So if we decide to set aside cash, then it's treated as an investment towards the project, right? And maybe as we start using our equipment or building, whatever assets we would need to acquire right away, as we use them more and more and more, we would need to be prepared to spend even more cash to cover any unforeseen expenses in the future. So maybe this cash reserve would need to be increased over time. And that means investing even more and more and more into this net working capital type, cash flow. So net working capital, change in net working capital throughout the project's life is a relevant cash flow. Then it's probably intuitive that taxes, so paying taxes on corporate income, let's say at 34% or something like that, is also a very important cash flow, a very important expense that all firms have to face. And then things like sales revenue, costs of production, which include fixed costs and variable costs, the initial investment, then depreciation, which is needed to find how much taxes we will owe to the IRS. Then we have this term salvage value, which will come up in maybe 10-15 slides. Salvage value is essentially when the project ends, how much money do we get when we sell all our assets, like the building, equipment, etc. And all those are also relevant. So, in general, these steps must be followed to calculate the net present value. Step 1, figure out which cash flows are relevant and which cash flows are not relevant. Step 2, only use the relevant cash flows to calculate the so-called project cash flow for each year. From chapter 2, project cash flow is also known as free cash flow. Okay, so in other words, 1 year at a time, starting year 0, all the way through the final year of our project, you need to put together all relevant cash flows for that year and sum them up as the project cash flow for that year. Once you're done with that part, and that's what this entire chapter is all about. How do we do this? Step number 2, right? So step number 2 is like the essence of chapter 10. Once we find that number for each year, then we can calculate the net present value by discounting all future project cash flows by the right number of years and then subtracting project's cash flow in year 0. When we find the net present value in dollars, we would then be able to evaluate this project. The project should be accepted if the net present value is above $0. Otherwise, if it's below $0, then we would say that the project should be rejected. So, how should we calculate project cash flows for each year? In general, to calculate project cash flow in year 0, project cash flow in year 1, project cash flow in year 2, and so on, we need to use this general formula. To find project cash flow, we need to sum up 3 things: project operating cash flow, OCF, project net capital spending, NCS, and project change in net working capital, change in NWC. So essentially, what this all means is that 1 year at a time, we calculate the operating cash flow, the net capital spending, the change in net working capital. Then, once we get these 3 numbers, we add them together, and that's the project cash flow for that specific year. And then we repeat the whole thing for each year of the project. Before we start looking at how do we calculate the operating cash flow, the net capital spending, the change in net working capital, let's look at the general idea behind each. Essentially, think of there being several relevant cash flows that, by their nature, the cash flows, what they have in common, so they have something in common, right? And that puts them in the category that we call operating cash flow. Other cash flows have something else that they all have in common. And they have nothing to do with operating cash flow, but instead they have to do with what we call net capital spending. And everything else would belong in the 3rd category of cash flows, which we call change in net working capital. So what is in the 1st category? What do we put together to find the operating cash flow? Essentially, it's everything that allows us to calculate the cash flow from sales that the project would generate every single year in the future. This is nothing but profit for the year. Profit after all expenses have been subtracted from the sales revenue, right? So operating cash flow is the same exact thing as profit. And this is something we need to calculate for each year of the project in the future, starting year 1. So you may think that, isn't that what the project is all about? It's just, calculating profits from whatever it is that we would be selling. Well, I would say yes, it is kind of the main thing, but there might be other things that the project would involve. So let's see what's the idea behind net capital spending. There are several different cash flows that belong in this category. The general idea is it's something that has to do with the long-term investment. So something you're going to be using for a very long term, such as a building, a few items of some equipment, some machinery, maybe laptops, maybe delivery trucks, whatever those fixed assets are. And typically, net capital spending is something that we need to worry about for the very beginning of the project, when we buy those buildings, equipment, trucks, laptops, etc., and the final year of the project, when we would be selling all of those used. Of course, there might be things going on in the years in between, such as maybe if we bought a building, after a few years we would need to maybe build some addition to the building, expand it, right? Add more square footage. So that would be an extra net capital spending sometime in the middle of the project's life. But in this chapter, the only cases that we will be looking at are the ones where we buy something in year 0. That's essentially what we call the initial investment. And when we sell that used in the final year of our project, right? There are a couple other things that belong in this category, such as opportunity cost, but like I already mentioned earlier, we are not going to be looking at something so complicated, like some alternative investment and how much you could have made there, how much you could have spent there. And then the third, so there might be other relevant cash flows which don't belong neither in the operating cash flow category, which has to do with like how we identify like how much profit we made for each year, nor in the net capital spending category, which has to do with buying something bulky, something large, big, expensive, like a building, equipment. Net working capital, you can think of it as small things that we may need to use for the project, like short-term investment related cash flows, such as maybe we need to set aside a few $100s in cash, so we can always have it lying around, always there, always handy, that we can you know, take the money out whenever something needs to be quickly repaired, right? Cash is technically not the only item that belongs to what we call net working capital. There are other items like inventory, accounts payable, accounts receivable that are also in this category. Okay, before we do a couple of big net present value problems in which all of this new information will be put together, let's first look in more detail at the operating cash flow type, you know, cash flows. So cash flows that belong in this category. And what is the formula to find the operating cash flow, right? Then we will look at net capital spending, what's included, what's the formula we use there, how do we calculate the net capital spending. And then finally, what is meant by change in net working capital. So we will have a few examples for each of these you know, parts of the slides. Let's start with the operating cash flow. The idea is it's nothing but annual profit from sales. So there is operating cash flow for year 1, for year 2, for year 3, and so on, with the last operating cash flow that needs to be calculated being for the final year of the investment project. However, operating cash flow is not the same thing as net income. So what exactly is it? How do we calculate profit for each year? If you go back to, you know, accounting, right? How would accountants do it? They would basically build you an income statement, one income statement for each year, for year 1, for year 2, and so on. What does a standard income statement look like? The first row is the sales revenue, the money that would be coming in from selling our product. And then everything that follows in the rows underneath is different expenses. First, we subtract the costs of goods sold, then we subtract depreciation. After subtracting these two items from the sales revenue, we get EBIT, which stands for earnings before interest and taxes. Then we subtract interest expenses on loans, which gives us taxable income or earnings before taxes, EBT. Then we multiply that by a certain corporate income tax rate that, you know, is applicable to this company. And after subtracting taxes, we are left with net income. So this is how accountants calculate profit for every year. However, there are a couple of things that we finance people are doing differently. First, remember from the earlier slides, interest expenses on loans are considered irrelevant for capital budgeting decisions, right? We are not going to use interest expenses in our net present value calculations, right? The second thing that we are gonna be careful about is net income. Is this really how much profit we make? Well, not exactly. It's actually understated. There is one item in this list of expenses that is not a true expense. It's a so-called non-cash item, and that's depreciation. Depreciation is not an actual cash expense. It's only there because of how we need to be calculating taxes correctly. It's only there for tax purposes. And so because depreciation is something we never spend, we need to add it back to correctly calculate the profit for the year. And this is how you can find the operating cash flow. So you can take net income, the last row of a standard income statement, and add the depreciation amount back to it. The textbook's definition of the operating cash flow is EBIT, earnings before interest and taxes, plus depreciation minus taxes. So by adding depreciation back to EBIT, we are essentially saying that we just have sales revenue minus cost of goods sold. And then the only thing that we subtract, the only other thing that we subtract is taxes. We are not subtracting interest expenses. Let's look at the following example. Let's say we are considering a new investment project, right? And we are now interested in calculating the operating cash flow for the first year of this project. Here's what we know about the first year. Over 1 year, a firm's sales revenue is expected to equal $50,000. Production costs would equal $30,000. Depreciation expense for tax purposes would equal $8,000. And corporate income tax rate is going to be 34%. How would you calculate the operating cash flow? Well, let's build the entire income statement first, and then we'll just pick the items that we need to follow the formula from the previous slide to find the OCF. The income statement would need to start with the $50,000 in sales revenue. Then we subtract production costs, minus $30,000. Then we subtract depreciation, minus $8,000, which gives us the earnings before interest and taxes. That's $12,000. Right? $12,000 is $50,000 minus $30,000 minus $8,000. Then we need to subtract the tax amount. We are given a 34% corporate income tax rate. If we multiply 34% by the taxable income, which is the EBIT of $12,000, we would get $4,080. After subtracting $4,080 in taxes from the taxable income of $12,000, we get the net income equal to $7,920. Now, how do you find the operating cash flow? Following the formula from the previous slide, we take EBIT, which is $12,000, we add depreciation back, so plus $8,000. And then we subtract taxes, minus $4,080. This gives us $15,920. This is the profit, the true profit that we would be earning over the first year of this investment opportunity. Turns out there are 3 more ways to find the operating cash flow: the bottom-up approach, the top-down approach, and the tax shield approach. The bottom-up approach says that we start at the bottom and then we go up and only subtract, so we add back depreciation, right? Net income plus depreciation. In the example we just looked at, that would be $7,920 in net income plus $8,000 in depreciation. This gives us $15,920, the same number we found on the last slide. How does the top-down approach work? Essentially, we start from the very top, from the sales revenue, and then we only subtract the expenses which are necessary to calculate the true profit for the year, or the operating cash flow. So sales revenue minus costs of producing. We don't subtract depreciation, we kind of skip it, and then we jump straight down to taxes and subtract those. When we do the math, $50,000 in sales revenue, minus $30,000 in costs, and minus $4,080 in taxes, that again gives us the same result, $15,920. And the last formula, this is actually formula number 4, that could also be used to find the operating cash flow, is called the tax shield approach. There is no specific order, like it's neither bottom-up nor top-down approach. The formula says, look at the difference between the sales revenue and the production costs, multiplied by 1 minus the tax rate, and then you add the so-called depreciation tax shield, which is the product of the depreciation amount and the tax rate. So depreciation tax shield means how much we're saving in taxes by being allowed to treat depreciation as an expense, right? When we are including depreciation as an expense, it lowers our taxable income, and so we are able to gain by paying less in taxes. So the depreciation tax shield is sort of this extra term that we add to sort of after-tax income that shows how much of a difference it makes when we are allowed to treat depreciation as an expense, as opposed to the case when we don't use it as an expense, right? If you put all numbers in this formula, so open parenthesis 50,000 minus 30,000, close parenthesis, multiplied by open parenthesis 1 minus 0.34, close parenthesis, plus 8,000 times 0.34, gives us $15,920. So once again, it's exactly the same answer as we got for the top-down approach, for the bottom-up approach, and in the formula we used on the earlier slides, which is how the operating cash flow is defined in our textbook. So it doesn't matter which approach you use. If you have a question, calculate the operating cash flow, you can pick any one of these 4 approaches that you like. So, question for you, which approach would you use? What's your favorite approach? Usually my students tell me immediately, oh, the bottom-up approach. And then I ask them why. And they always say, well, it's only 2 numbers. And then I tell them, you know what? My favorite is the last one, the tax shield approach. And then they ask me why, and I tell them that this is the easiest one. And then they are all confused. So take a look at how the bottom-up approach works. It's true that there are only two numbers, but you're not given the net income. You need to go through the entire income statement to first find the net income, and only then you are working with just two numbers. Then students often tell me, okay, fine, I'll use the top-down approach. It's only three numbers there. And I tell them, you know what? Are you ever given taxes? No. You're given a tax rate, but not the tax amount. To find the tax amount, you again need to go through almost every row of an income statement until you can calculate the taxes. And then after this kind of discussion, the class sort of agrees with me that the tax shield approach seems to be the easiest one to use. Or at least there are no preliminary calculations you need to do first. Because typically the sales revenue is given, the production costs are given, and the depreciation is given. You don't need to calculate anything first before you use this OCF formula. But in general, it's completely up to you. All approaches, all formulas, all four of them give the same numerical answer, and you can use whichever one you like better. Net capital spending. This is the second part of the total cash flow that we need to calculate for each year of an investment project. What are the main components? So what kind of cash flows belong into this category that we call net capital spending? Typically, this is something that we calculate for year zero, when the project would begin, and the final year. In year zero, there's a big amount of money that is spent, right? We're buying a new fixed asset. For example, it could be a building or a piece of equipment, a laptop, anything that would make the production possible. So we spend money in year zero on buying such example of fixed asset. And then in the final year, we are going to be selling it. And the money we collect when we sell something is called salvage value. There could also be more than just these two items going on. For example, maybe there is one more thing that's happening in year zero when the new project would start. And that's selling some existing old asset, right? So maybe we are selling something that's already very old and replacing it with a brand new asset. And then in this case, because we receive money received from selling some old asset, and we spend money to buy a new asset, we need to only consider the difference. What is the net amount of money that would be spent in year zero? From these three, we will only be considering the first and the last one. So both are related to buying the same fixed asset and then selling it when the project ends. Let's look at the following example. A firm wants to buy a new machine which will make production more efficient. It will cost $80,000 to purchase the new machine today. It can get $30,000 for selling the machine when it will be sold in 2 years. What is the net capital spending related to this machine? Okay, so it's a short timeline with year zero, which is today, year one, and year two on it. And we are going to start, using the machine today, and we would stop using it after exactly 2 years. So we will be spending $80,000 on buying the machine now, and when we sell it in 2 years, we will get to keep $30,000, right? To answer this question, you actually don't need to find some sort of, difference between 80,000 and 30,000. You just, separate the two dollar amounts because they occur at different points of time. So for this question, you would say that the project net capital spending in year 0 is $80,000, which is spent, and in 2 years it's $30,000, which is the money received. You don't need to combine them. Okay, so $80,000 is simply the purchase price of the new machine. This is also what we used to call the initial cost or the initial investment. For example, in the previous chapter, chapter 9. Now, what is $30,000 that we get from selling the machine in 2 years? This is actually not simply the sale price. It's not what some buyer would be paying you. It's what we call salvage value. Actually, the most accurate term is the after-tax salvage value. And it reflects more than just the sale price. So let's see what exactly is going on. The salvage value, or the money we receive when we sell an asset, to be more precise, it's the after-tax salvage value, as we are going to be calling it soon. It depends on 2 things. Market sale price, so that's basically the price that some buyer pays you. But it's not just that, it also depends on the book value at the time of sale. Let's see how the two are related to each other. So when a firm buys a physical asset, the purchase price that it pays for it becomes its initial book value. So the initial book value, or the original purchase price, is sort of the highest point on the how the value of an asset changes over time. And the value changing over time reflects, the wear and tear, right? The asset getting older, losing its value. So according to the IRS, depreciation is, how much value is lost. And it's considered to be an income tax deduction that allows a taxpayer to recover the cost or other basis of certain property. Then, as the IRS.gov website continues, it is an annual allowance for the wear and tear, deterioration of the property. Most types of tangible property, except for land, such as buildings, machinery, vehicles, furniture, and equipment, are depreciable. Likewise, certain intangible property, such as patents, copyrights, and computer software, is depreciable as well. So, annual depreciation is how much value is lost for that specific year. And according to the IRS, regulations, that amount can be treated as an income tax deduction. So it can be tax deducted. What this means is our taxable income on which we pay taxes is lowered by the amount of the annual depreciation in that year. So we treat it as an expense in an income statement for that specific year. What happens next? 1 year goes by, we see some depreciation, right? The asset has lost some of its value. The second year goes by, more value is lost. So as the firm uses the asset for business, over the years, the accumulated depreciation increases. And because of that, the remaining book value decreases. And we can say that at any point of time, we can calculate how much the asset is still worth, or the remaining book value. And that equals the original purchase price, which by default is the initial book value, minus the accumulated depreciation since the time the asset was purchased. Okay, so let's say another year goes by and another year goes by. So maybe 4 years went by since the purchase, right? The firm eventually decides to sell the asset. How much money will it get back? It will get the amount of money that we call the after-tax salvage value. Sometimes we call it salvage value, but we really mean the after-tax salvage value. And this amount of money that we get to put in our pocket directly depends on the remaining book value. The after-tax salvage value may actually be pretty simple, just exactly equal to the sale price. However, it may end up being less than the sale price or higher than the sale price. So let's look at these two situations, below or above the sale price. When do we get more than the sale price? We put more money in our pocket than how much some buyer pays to us whenever the remaining book value at the time of sale is more than the price at which we are selling the asset. So you can imagine the initial book value being our starting point, and then we sort of like walking downstairs, and each step that we make is the lost value or the depreciation amount. So if at the time of sale the remaining book value is above the sale price, this is the situation in which you are going to be looking at tax savings or a tax refund to you from the IRS. Why? Because you're getting a tax refund because you have been overpaying taxes over time. How do you know that this is what's happening? Well, when the remaining book value is high at the time of sale, it means that as if the asset has not been losing enough value, right, since the time it was purchased. Because now somebody is only willing us to pay this much money, which is below how much the asset is worth on the books, right? So it's like it's really worth less than what accountants have calculated. So because the depreciation appears to have been too low each year, it means that our taxable income must have been too high over the last years. And a high taxable income means that we have been paying too much in taxes to the government. And so now it's time to get a tax refund. And so the sale proceeds, or the after-tax salvage value, when the tax refund is considered, will equal how much some buyer is paying us, or the sale price, plus the whole tax savings amount, which is calculated by looking at the difference between the remaining book value and the sale price and multiplying that dollar difference by the tax rate which is given to us. The opposite situation is when we will sell the asset used for some amount of money that some buyer will be paying us. However, we are not going to be able to put all of that in our pocket. So the firm will get back less than the sale price if the remaining book value is below the sale price. And exactly the opposite explanation can be presented to explain what's going on, why we are going to have a so-called tax liability. We are going to have a tax liability because this situation implies that we have been underpaying taxes over time. So the intuition is the remaining book value is lower than the sale price because, so essentially it's as if we're trying to sell the asset at a profit, right? So we are going to be taxed on that amount. the profit amount. But you can also say something like the following. You can say that it's as if the depreciation has been way too high. On the books, the asset is worth very little, whereas buyers are willing to pay a good price for it. So if the depreciation has been way too high, then you have been deducting too much money from your taxable income, right? And that implies that you have been paying very little money in taxes to the government. So now it's the time for you to pay some underpaid taxes back to the IRS. The formula that we will use to calculate the sale proceeds or the after-tax salvage value that considers this tax liability is actually very similar to what we had for the opposite case with the tax savings. Here, we are going to end up putting less than the sale price in our pocket. And how much less? That's the tax liability. The tax liability is calculated by looking at by how much the selling price exceeds the remaining book value and taking that dollar amount and multiplying by the tax rate. So what you get is how much would need to be subtracted from the sale price and paid to the IRS. And after that, what's left is your sale proceeds and what you can put in your pocket. Okay, now that we know sort of the different situations that can take place at sale and how they relate to, the asset losing money or depreciating over time. So now, how exactly do assets depreciate over time? There are two commonly used methods for depreciation of different assets. Case 1 is the so-called straight line depreciation. Case 2 is the so-called depreciation under MACRS, which stands for Modified Accelerated Cost Recovery System. The straight line depreciation, case number 1, is not as common as case 2. And every asset follows either the straight line or the MACRS depreciation. So that information is always what you would call given. What depreciates according to the straight line depreciation? Buildings and intangible properties such as patents, software. Everything else like equipment, vehicles, they follow the MACRS. Now let's see how the two compare. Let's start with the straight line depreciation. To find the annual depreciation, you need to evenly distribute the cost of your asset over the asset's useful life or economic life. So let's say the useful life of some piece of equipment is 10 years, and that is given to you. Then you take the price that you will be paying and divide it by 10. So this gives you 1/10 of the purchase price in annual depreciation. So this is how much value is lost every year. Same amount every year. And this is actually the key. The depreciation is the same every year. So if you imagine, having the purchase price is your original book value, then you can imagine going like downstairs, with steps having the same height, right? So each step you take is the same depreciation amount, same value lost every year. If you're then interested in calculating how much value has been lost over a specific number of years, then we take that number of years and multiply by the annual depreciation. So for example, after 5 years, we have 5 multiplied by the annual depreciation amount. That's the accumulated depreciation. Then after any number of years, we can calculate how much value remains, or the remaining book value. For that, we take the original book value, which is the purchase price, and we subtract all the accumulated depreciation until then. So if the economic life is 10 years, then after let's say 3 years, there's 7 years worth of value remaining. Let's look at the following example. A company is buying a new piece of equipment for $12,000. Its economic life is 3 years. It will depreciate at the same rate each year. The company is planning to sell it in 2 years for $3,000. TC, which stands for corporate income tax rate, equals 34%. What will be the after-tax salvage value? Okay, we can build a table that shows for each year, including the very beginning, year 0, what the annual depreciation will be, the accumulated depreciation as of end of that year, and the remaining book value as of end of that year. So right away, the remaining book value is $12,000, which is the purchase price. Over the first year, we lose 1/3 of the asset's value. We know that it's 1/3 because the economic life is 3 years. So 1/3 of the original book value is 1/3 of $12,000, which gives $4,000. And $4,000 is also the annual depreciation in years 2 and 3, right? So for the entire life of this equipment, for the entire 3-year economic life, the depreciation per year will be the same dollar amount, $4,000. For each year, we can also calculate the accumulated depreciation. After the first year, we have lost $4,000 in value. After the second year, we have lost 2 years worth of depreciation. So 2 multiplied by $4,000 gives $8,000. And after 3 years, all value is lost. So 3 multiplied by $4,000 per year gives $12,000, which is how it should be, right? Because the equipment has a 3-year economic life, after the 3rd year, the accumulated depreciation should be exactly equal to the initial book value. Another thing you can say is that after the end of the economic life of your equipment, the remaining book value should equal 0. So what's the remaining book value after the first year? We lost $4,000 in depreciation, so the remaining book value is $12,000 initially minus $4,000 during the first year equals $8,000. What is the remaining book value after 2 years? Well, we started with $12,000 in year 0, and we lost a total of $8,000 in depreciation over 2 years. So we have only $4,000 of value remaining. And the remaining book value after 3 years is the initial book value, $12,000, minus accumulated depreciation over 3 years, which is also $12,000. And this is how we get 0. So we start with 12,000, then the value drops to 8,000, then it drops to 4,000, and then to $0, right? And if you connect these sort of imaginary points that kind of indicate the loss in value every year, they would be connected with a straight line. This is, by the way, where the name straight line depreciation comes from. Okay, and now let's go back to our question. What will be the after-tax salvage value? So what information do we need you need to answer this question? You only need to look at the selling price, which is $3,000, and you need to compare it against the remaining book value, which is $4,000, right, at the end of the second year. So end of year 2 is the only year that we should now focus on. Because we are selling the asset for less than what it's worth, we are kind of selling it at a loss. And we had an explanation of one of the earlier slides, which explained how this corresponds to the case that we call tax savings. So how much taxes are we going to get back from the IRS? We're going to get back the difference between 4,000 and 3,000 multiplied by the 34% tax rate which was given. The tax savings is equal to $340, and we're going to add it to the $3,000 selling price to correctly calculate the so-called after-tax salvage value that we get to keep. So the after-tax salvage value equals $3,000, the selling price, plus the tax savings, $340, which gives us $3,340. The second type of depreciation, which applies to most fixed assets such as equipment, trucks, is called depreciation under MACRS, Modified Accelerated Cost Recovery Systems. Essentially, the way we calculate the annual depreciation, the accumulated depreciation over n years, and the remaining book value at the end of the nth year are the same as for the straight line depreciation. The only difference is the depreciation is not the same each year. So it's not the same percentage of original value that would be lost every year. It's a different percentage. The part of the term accelerated refers to the idea that a lot more value is lost early on when the asset is put into use than later on towards the end of its economic life. So we don't get like a straight line between the remaining book value points. For each year we get a curve. It's steeper in the beginning and then it gets flatter and flatter. There are actually different classes, asset classes, and they each have like their own rule for how much value is lost every year. Then there's something called the mid-year convention, which means that all assets are treated as if they're placed in service at mid-year. So not January 1st, but sometime on average, let's say in June, right? Which means that if it's, let's say, a 3-year class asset, then the 3-year economic life will be, covering 4 calendar years, at least partially, right? And so when you look at, an example of these tables that I was mentioning, let's say a 3-year property class, a 5-year property class, a 7-year property class, you will notice that for the 3-year class, there are depreciation rates not for 3 but for 4 years. For the 5-year class, you see depreciation rates over 6 years. For the 7-year class, we see 8 depreciation rates for 8 years. So it's always given which property class our asset falls into. Let's say problem may say it's a 3-year property class. In general, in real life, this would be special tools for manufacturing, equipment used for research. 5-year property class assets include things like computers, monitors, printers, refrigerators, cars. And 7-year property class includes assets like office furniture and equipment and most industrial equipment. On the irs.gov website, you can find a lot more different types of property classes. But we are not interested in going that deep into this topic. So in this chapter, we will only be referring to table 10.7 in the textbook, which summarizes the percentage of the original value that is lost every year. As an example, let's say we are buying an asset for $10,000, and it's a 3-year property class. Year 1 is 33.33%, which means out of that initial value that we had, what was it? I think I said $10,000, right? Out of that number, 33.33% will be lost in the first year. So that would be $3,333 in the depreciation for year 1. The second year depreciation would be 44.44% of the same original book value. So if that was $10,000, then $4,444 is lost during the second year. So this is how you calculate the depreciation for each year, one by one. And it's not the same depreciation amount, which was the case with the straight line depreciation method. Let's look at the same example we had earlier for the straight line depreciation method and change one thing about it. This time, the equipment that we will be buying will depreciate according to the 3-year property class under makers. The rest of the information is the same as before. A company is buying a new piece of equipment for $12,000. Its economic life is 3 years. The company is planning to sell it in 2 years for $3,000. The tax rate is 34%. What will be the after-tax salvage value? Using the table 10.7 from the textbook with depreciation rates for different years for different property classes, we would look up the table for the 3-year property class under makers, right? And it says that during the first year, 33.33% of $12,000 would be lost. That's $4,000. During the second year, 44.44% of $12,000 would be lost during the second year, right? Which is $5,333. Then 14.82% of $12,000 will be lost as depreciation during the third year, and so on. We don't really need to go all the way through year 3 and 4. We can actually only do years 1 and 2, because at the end of the second year, this equipment would be sold, right? So what do we need to calculate after finding the annual depreciations for years 1 and 2? We add them up. That's the accumulated depreciation over the first 2 years. So $4,000 over the first year plus $5,333 over the second year equals $9,333 over the first 2 years. When we subtract $9,333 from the initial book value of $12,000, we get the remaining book value at the end of the second year, $2,667. And notice how the value drops unevenly over the economic life of this equipment. So there are different drops over different years. What do we do next with this information? We then can calculate how much money we get to put in our pocket when we sell the equipment after 2 years. We will be selling it for $3,000, which is given, and that's more than the remaining book value at that time, $2,667. This is the situation that we call a tax liability, because it's like you're selling something for more than it's worth. You're selling it at a profit. You'll be taxed on that. And I also had an explanation of on one of the earlier slides about how this implies that the company has been paying too little in taxes over the 2 years. So how much liability are we going to be facing? We're going to be paying a tax on this difference between the selling price and the actual book value. We take the difference, $3,000 minus $2,667, and multiply that difference by the tax rate of 34%. This gives us the tax liability of $113.22. We then need to subtract it from the $3,000 selling price. And when we do that, we will get the correct estimate for how much money we will get to keep to ourselves, or the after-tax salvage value. And that will equal $2,886.78. Let's look at the third one of the 3 components of the total cash flow that we need to find for every year of our investment project. This one is called change in net working capital. So why do we need the word change? Can we just say net working capital for each year? And first of all, what do we mean by net working capital? So let's cover all that on the next few slides. By definition, net working capital, or NWC, is equal to current assets minus current liabilities. From a standard balance sheet, current assets are on the left, part of total assets, and they include everything that's cash or like cash, so something that could be quickly and easily sold for cash. So the 3 main components are cash, inventory, and accounts receivable. Accounts receivable is when somebody else owes money to the company. For example, if the company sells its product on credit, then the amount of money that's has not been received yet is temporarily recorded under accounts receivable. Current liabilities include accounts payable, and they also include short-term loans. So current assets minus current liabilities, the difference between the two, reflects how much the cushion that the company has invested its cash into, so that the current liabilities can be covered as needed, and there is more remaining, right? What do we mean by change in net working capital? Change means when over 1 year we have increased the amount of net working capital. So for example, what does it mean that the change in net working capital for some year is positive? That will happen if a firm invested more money into current assets. For example, it set aside more cash, or increased its inventory, which cost its money, right? Or increased how much money somebody else owes the firm, which is like, the money that it's missing out on, right? Or the net working capital is positive if instead the current liabilities have been decreased, right? So it means, if we decrease current liabilities, it means we paid off some of our short-term debt, right? And paying it off means that the money has left the firm. So that's kind of, a bad thing. We have paid money, right? And if we set aside cash or increase inventory, it also implies paying money. So either one of the two, or a combination of both, it results in the change in net working capital that is positive. Negative would be the other way around. So negative change in net working capital means that rather than investing money, we receive money. So how can we receive money? If we, for example, sell inventory, right? So we have less inventory, or we have less in accounts payable to us, which means that whatever somebody owed us, now they paid that amount back to us. So we have collected some cash. And if we instead invest more money into current liabilities, it means that we now owe more money, right, to somebody else. And how would that happen? If we borrow more, so we have extra cash, right? So a positive net working capital means we spend money. A negative change in net working capital means we receive money. If the change in net working capital for some year is 0, it means that, for example, we kept the same amount of cash on hand as we did last year. So the cash account has not changed. Or maybe what has not changed is the accounts payable, or inventory, or accounts receivable, right? So any of these components of current assets or current liabilities should be unchanged from one year to the next. That's how we get the change in net working capital as $0. So it's kind of like a lot of different examples that I'm mentioning here: cash, accounts payable, accounts receivable, inventory. To make it easier, let me use just cash, kind of the easiest one to think about, to explain how the calculations would work. So let's look at the following example. Let's say the FRL department, or maybe it's just some company's name in general, right, decided to spend $5,000 to buy a brand new Xerox machine for its faculty, or maybe its employees, right, more generally. It is estimated to last 4 years. It will be necessary to immediately set aside $400 in cash as a buffer against unforeseen repair costs. This amount will be increasing by 50% each following year until the cash buffer is no longer needed by the end of the final year of the machine life. Calculate the change in net working capital for each year. So 1 year at a time, we need to see how the net working capital would be changing. And the net working capital in this problem is just cash. So only cash and nothing else. So you can think of everything else still being there, just not changing. So cash is the only part of net working capital that would be changing as part of this project. Okay, so it's a 4-year project, right? So we can imagine like a timeline with year 0, which is today, or when this project would begin: year 1, year 2, year 3, year 4. So if we immediately set aside $400 in cash, it means we immediately invest this amount of money. So the immediate net working capital that would be planned for this project is $400. That's money spent. What will be the net working capital, or think about the total cash reserve, cash buffer, right, as of end of year 1? So what do we know in this problem? This amount of cash will be increasing by 50% each year, right? So what is 50% more than $400 in year 0? We can calculate it by multiplying 400 by 150% of that, or by multiplying by 1.5, which gives $600. So as of end of year 1, we will have a total of $600 as our cash reserve. Then we do the same thing again. We increase this cash reserve by another 50%. So as of end of year 2, our cash reserve will be larger. What's 50% more than $600? We do $600 multiplied by 1.5, which is the same thing as 150%, and that gives $900. Then end of year 3, same math applies. $900 multiplied by 1.5, which gives $1,350. So this is the total cash reserve as of end of year 3. And now we are moving to the last year, right? What does the problem say? The cash buffer is no longer needed by the end of the final year of the machine life. The final year is the 4th year. So if the cash buffer will be no longer needed, it means all the cash reserve that we would have by that time can go down to zero, right? $0. And this is exactly what we would need to put for the end of the final year. You can think of it as a rule. The net working capital at the very end of any project will always be equal to $0. However, this is not the answer to this problem, because the answer to the problem is calculating the change in net working capital for each year. So why is it important? What is the difference between net working capital and change in net working capital? So think of it this way. If I tell you that we invest $400 in cash right away for this project, then we invest another $600 after 1 year, and then another $900 and so on, that would actually be wrong, because during the first year we do not invest additional $600. Out of the total $600 reserve, $400 are from the year before, right? So we would be double counting $400 if we say that during the first year we set aside additional $600. So how much do we set aside during the first year? Okay, so the immediate change is 400, kind of where we started, but then the additional or the incremental, so I'm now using the terminology from the beginning of this chapter, the incremental cash flow during the first year is $200. So $200 is actually the 50% increase, right? More generally, to find the change in net working capital for any year, you look at the difference in the net working capital between the year before and that year. So the difference between $400 in year 0 and $600 in year 1 is $200. And that's the change in net working capital over the first year. Now, the same way we can look at how much extra cash would be set aside during the second year. From the first row, where we have the total cash reserve, we need to see how this cash reserve would change. And we see that it would increase from $600 to $900. That's a 50% increase that was given, which in dollars equals $300. Then the same way we calculate the change in net working capital for the third year. So that's the difference between $900 in the net working capital in year 2 and $1,350 for end of year 3. That's $450. And now we go to the final year of this project. In the final year, things are again slightly different. Remember we said that the buffer will no longer be needed, right? So we recover the entire cash reserve that was set aside until the end, right? Kind of towards the end of the project. So there are actually a couple of ways to figure out what the change in net working capital is during the fourth year. Either the same way I did for all previous years, which would be the difference between $1,350 and 0, right? So that gives what? So what is 0, the new number, minus the old number, 1350. It's 1350, but kind of with the opposite sign, right? And actually, I put the word recover here. So recover means that it's the opposite of investing, the opposite of setting aside extra cash. So rather than investing more, we sort of take it out of the project. We take it back. So it's a cash inflow for the firm, for us, and it's a so-called free cash flow that we can now put to use for anything else we like. Another way to calculate this final change in net working capital is to look at the sum of all changes in net working capital until the final year. So if you add up 400 plus 200 plus 300 plus 450, you would get 1350. So either kind of look diagonally at net working capital for the previous year, right? Or look at sort of across same row, change in net working capital, and sum together, add up all the changes in net working capital that occurred in all previous years. Just to emphasize, all the changes in net working capital in this numerical example, all the way until the final year, are cash outflows to the firm, money that is invested. So you can put a negative sign in front of all of this, in front of $400, in front of $200, in front of $300, and in front of $450. But the amount that's recovered at the very end, which is the sum of all those cash outflows, is a cash inflow. So you can also put a plus sign in front of it, sort of to make it more clear, to make it clearer that it's the money that would be coming in. Okay, so this is, I would say, on the, difficult side, like this type of net working capital information and how you sort of process it to get the incremental changes, right? The changes in net working capital. What would be other cases? So maybe we have the same problem. Oh, by the way, $5,000 was sort of irrelevant for what the question was asking. Kind of only there to confuse you. Let's say the problem is worded a little bit differently. It will be necessary to immediately set aside $400 in cash, and the amount will be increasing by 50% each following year, period. So if you remove the rest of the sentence, if there is no mentioning of recovering, the cash buffer at the end, what would it change? Actually, nothing. Everything would be the same. So you should always assume that the entire net working capital that was invested for any project would be recovered at the end, which means the total net working capital would be $0 at the end in the final year. Another variation of this problem would be, let's say we immediately set aside $400 in cash, period. No mention of how this would change. How would the timeline change? Well, if we set aside $400 right away, then it stays at $400, total $400 every year. So for the net working capital, we would have $400 in year 0, again $400 as of end of year 1, because there is no change, $400 again in year 2, another $400 in year 3, and as always, 0 in year 4. As for the changes in the net working capital, the immediate change is still $400, but then we would have $0, $0, $0, and in the final year, we would recover $400, right? That was set aside, a long time ago. So these are kind of the different variations of, how the net working capital could be given in capital budgeting problem. It could also say that there are not going to be any changes in the net working capital. Then you have sort of no dollar amounts at all. It's just all blank. Okay, so this was the third one of the three components of the total cash flow that needs to be calculated for every year of a proposed investment project. And so what were the three components? Operating cash flow, which is like profit from sales. Net capital spending, which is like buying all the big equipment items or buildings in year 0 and then selling them in the final year. And the change in net working capital, which, as you can see, is something that could be taking place every single year in our project. Now let's put all of the above together. Let's cover, the following capital budgeting example. Capital budgeting basically means a long-term investment decision, and it also means, basically it means calculate the net present value. Technically, there are other methods to evaluate an investment opportunity, like we saw in Chapter 9, such as the internal rate of return approach, the profitability index approach, and the payback period approach. But in the previous chapter, we saw how every approach has its own advantages and disadvantages, but the net present value approach is by far kind of the cleanest one of all. It has the fewest problems with it. Okay, let's look at the following example. Let's say Cal Poly, or more generally, a company, is considering opening a pizza restaurant in the, on campus, right? It will cost $100,000 to buy all the necessary equipment, furniture, and pay for the interior design. So what is $100,000? That's the initial investment. That's also, that also belongs to the net capital spending category of cash flows, right? The restaurant will be operating for 4 years, after which all assets are expected to be sold at a market price of $30,000. The restaurant's equipment falls into the 5-year property class under modified accelerated cost recovery systems. Rent and other fixed costs will equal $10,000 per year, and variable costs will be 20% of the sales revenue. 15,000, 20,000, 25,000, and 30,000 pizzas will be sold in years 1, 2, 3, and 4 at $10 each. The management will also need to immediately set aside and keep each year $2,000 in cash to cover unforeseen expenditures, and this amount will be fully recovered by the end of the project's life. Corporate tax rate equals 34%, and annual interest rate is 10%. Is it worth opening this restaurant? So we need to calculate the net present value. If it's above $0, then we will say it's worth opening the restaurant. To find the net present value, we need to discount all cash flows using the discount rate, which is 10%. So what are the cash flows that need to be discounted at 10%? That's the whole point of this problem. We need to figure them out from all this information. The correct first step would be to, sort out anything that may be irrelevant. So are there any dollar amounts that we would call irrelevant? Remember, there are 2 types of cash flows that we call irrelevant from, the earlier slides in this chapter. And the 2 types of irrelevant cash flows are sunk costs, which is something that has already occurred before we would be making this decision regarding the restaurant. Do we have anything like that? Actually, we do not. So we don't have any sunk costs. The other type of irrelevant cash flows is financing expenses, which means anything related to a loan, making payments on a loan. Do we have anything here about taking a loan to cover part of this $100,000 purchase of the equipment? No. So every single number you see here that's given is relevant, which means we will need to use every single number here somewhere in our calculations of the cash flows, which would then be discounted at 10% to find the net present value to figure out if the restaurant is a good idea. So there are kind of different ways how you write down your numbers when you do the math. It's common to use a negative sign for cash outflows when the money is spent, and no sign at all or a plus sign for cash inflows or money received. And that's what I will be, trying to stick to in my calculations. Okay, so kind of going backwards, we need to find the NPV. That would be our last step. If the net present value is positive, then the project should be accepted, right? So that's the evaluation step. But before that, we need to, they actually calculate the net present value. And for that, we will use the total cash flows, discount them at the known discount rate. And this is where we can use the cash flow keys in the financial calculator. So how do you find the total cash flows for the cash flow keys? For that, one year at a time, and that would be our step number one, we calculate three things. First, calculate the operating cash flow, OCF. Second, calculate the net capital spending, NCS. And third, calculate the change in net working capital, or delta, NWC. Once we have three for each year, we would then add them up to calculate the total cash flow from this project for each year. Okay, so let's do step one, calculating operating cash flow for each year. So here's what we are already given. We will sell 15,000 pizzas in the first year, 20,000 pizzas in the second year, 25,000 pizzas in the third year, and 30,000 pizzas in the fourth year. The price per pizza will always be $10 every year. So this allows us to calculate what? It allows us to calculate the sales revenue. Why do we even need the sales revenue? Well, we need to find the operating cash flow. If you go back a few slides where the operating cash flow was first introduced, you would see that there are 4 different formulas that could be used. They all give the same numerical answer. And I explained on those slides that my favorite formula is this one, where it looks at the sales revenue minus production costs. That difference is multiplied by 1 minus the tax rate, and then we add the product of the annual depreciation and the tax rate. This is the so-called depreciation tax shield approach to calculating the operating cash flow for each year. And the reason I'm using this one, and that's what I explained on my earlier slides, is because this is the fastest way to find the operating cash flow. The other versions of this formula have net income or taxes. And for that, you need to do extra calculation steps. So the depreciation tax shield approach does not need as many sort of preliminary calculations for it. Okay, so if you look at this depreciation tax shield formula, then we need 3 big things: sales revenue, production costs, and depreciation for the year. And this is why we are calculating the sales revenue for every year first. And the sales revenue is the number of units times the price per unit. So the number of pizzas multiplied by the price per pizza. What is the sales revenue in the first year? It's 15,000 pizzas multiplied by $10 each, which gives $150,000. For the year for year 2, the sales revenue will be $200,000. For year 3, the sales revenue will equal $250,000. For year 4, the sales revenue will equal $300,000. Okay, so we're done with the sales revenue part of the operating cash flow formula. What else needs to go in the formula? Costs. That's production costs. You can also call it costs of goods sold, COGS. That's what's commonly found in an income statement. Costs here include fixed costs, which are given $10,000 per year, and variable costs. And what was given to us is that to calculate the variable cost, we need to take the sales revenue and multiply it by 20%. So the idea is variable costs, they vary with how much we sell. So if we produce more pizzas, we are employing workers over time, we are paying them higher wages, we are also using more electricity and other utilities, and so that all adds up to higher costs. But fixed costs, on the other hand, are fixed. They don't increase if we produce more pizzas or decrease if we produce fewer pizzas. So maybe we are renting some equipment, right? So it doesn't matter how much we use it. We are just paying a flat fee every month. Anyway, variable costs are 20% of the sales revenue. What are the variable costs in year 1? Sales revenue in year 1 is $150,000. We multiply that by 20% and get $30,000. For year 2, it's 20% of $200,000 in sales revenue, which gives $40,000, and so on. In year 3, the variable costs will equal $50,000. In year 4, the variable costs will equal $60,000. Combining fixed and variable costs gives us total cost for each year. So $10,000 in fixed costs and $30,000 in variable costs gives a total of $40,000 in total production costs during the first year. In years 2, 3, and 4, the total costs are $50,000, $60,000, and $70,000. Okay, so you can put like a check mark next to costs in the OCF formula. So we have the sales revenue, we have the costs, the tax rate is given. What is the depreciation? Okay, so what we know is the furniture and all other equipment falls into the 5-year property class under makers, right? So we can look up the table that shows how much of the asset's value is lost, or what the depreciation is during each year of the product's life. And the percentages under makers are not the same as would be the case for the straight line depreciation. It will be a different percentage, right? A different fraction of initial value that is lost due to depreciation in each year. Okay, so it's 20% in the first year, according to that makers table for the 5-year property class. 20% of what? 20% of the initial value. What's the initial value? That's by default how much we are paying to buy all the equipment in year 0. And that's given, $100,000. So for every year of this 4-year project, we would need to take $100,000, the initial investment or the initial book value, and multiply it by the respective depreciation rate for that year. So for year 1, it's a 20% depreciation rate multiplied by $100,000, which gives $20,000. For the second year, the depreciation rate is 32%, which gives $32,000 in depreciation for that year. For year 3, the depreciation rate is 19.2%, which gives $19,200 in depreciation. And for the fourth year, the depreciation rate is 11.5%, which gives $11,500 in depreciation. Okay, now we have all the components that we needed to find the operating cash flow using the depreciation tax shield approach. So when we put the sales revenue, the total cost, and the depreciation, and the 34% tax rate into, this formula, we get for year one, $79,400, for year two, $109,880, and for year three, $131,928, and for the fourth year, $155,710. Okay, so it's a different number for each year. The sales revenue is growing because we are expecting to sell more pizzas. Because we will be selling more pizzas, the variable costs will be growing. That results in higher overall costs, production costs. And on top of everything, we are dealing with the maker's depreciation method, which has a different depreciation amount for each year. Okay, second step, net capital spending for each year. From the last slide, we know what the depreciation amounts are in dollars for each year of this project. If we add them up, that will be the accumulated depreciation. If we subtract the accumulated depreciation from the initial book value of $100,000, we will get the remaining book value at the end of the project, at the end of the fourth year. So $100,000 minus $20,000 in depreciation in the first year, minus $32,000 in depreciation in the second year, minus $19,200 in depreciation in the third year, and minus $11,500 in depreciation in the fourth year, gives $17,300. Why do we need the remaining book value? Because at the end of the last year, we would be selling all equipment. It will be sold as used, right? And that will bring us extra money, right? The sales proceeds. Except even though we are selling the equipment for $30,000, which was given, this is not necessarily how much we'll get to put in our pocket. So what's happening in this problem is something that is going to be worth $17,300 is estimated to sell for significantly more money, $30,000. So it's like we are expecting to sell it at a huge profit. And the IRS is gonna like it because it's gonna ask us to pay tax on that profit. And so instead of being able to put the entire selling price of $30,000 into our pocket, we are gonna, be allowed to put less than that after paying the tax. So long story short, we need to use the after-tax salvage value formula. On one of my earlier slides where I talked about the formula, I showed two versions of it. And I mentioned that it doesn't matter which one of the two versions you use. Mathematically, they give the same answer. So I use the formula which says selling price, $30,000, minus tax rate, 34%, multiplied by $30,000, the selling price again, less the remaining book value, $17,300. When you do the math, you get the after-tax salvage value equal to $25,682. So this is how much we receive, a cash inflow, at the end of the fourth year, on top of the profit from selling pizzas that we did as the operating cash flow on the previous slide. So the after-tax salvage value is one of the components of the net capital spending. Another one is for year 0, the initial investment, and that's already given. We are going to have to invest $100,000 to buy all equipment, furniture, and so on. So to summarize, the net capital spending related to this 4-year project includes $100,000 spent in year 0 and $25,682 received at the end of the 4th year. And there's nothing in years 1, 2, and 3. It's all blank. Okay. Next, calculate project change in net working capital for each year. So what do we know about the net working capital? We know that we would need to immediately set aside $2,000 and keep it at that level each year. So the net working capital will equal $2,000 invested right away. It will remain the same throughout the project and will be recovered at the end of the 4th year. And at the end of the final year, you should always put $0. I mentioned that earlier when I was covering the change in net working capital topic. So we have minus $2,000 in year 0, an immediate drop or investment, right? Cash outflow. Then it's another, well, I shouldn't say another because I don't want to confuse you. You put $2,000 negative under year 1, which indicates that we have the same total amount of cash in our reserve as of end of year 1. So it does not mean that we have added another 2,000. It means that the total reserve is still 2,000 as it was in year 0. And it's still $2,000 at the end of year 2 and at the end of year 3. Now, how does this cash reserve change over time? The immediate change is $2,000 in year 0. Then it does not change, which means you put $0 or, leave it blank for years 1, 2, 3. In the 4th year, because it's recovered, we're going to get our $2,000 back. So the project sort of gives it back to us. Now we are free to use it for anything else where it's more needed. So the $2,000 recovered at the end, you can put a plus sign next to it because it's like a cash inflow. It is a cash inflow. Okay, so we have just calculated the 3 important components of the total cash flow for each year: the operating cash flow, the net capital spending, and the change in net working capital. Notice how the operating cash flow starts in year 1. So we have it for years 1, 2, 3, and 4 because it's profit from selling pizzas, right? And we look at profits as if they're collected at the end of each year rather than continuously throughout each year. Net capital spending is only there for years 0 and 4. Year 0, we buy all equipment. Year 4, we sell it. So cash outflow in year 0, cash inflow in year 4. Change in net working capital, we only have it for years 0 and 4. In year 0, we set aside $2,000 in cash, just in case, to cover any unforeseen repairs. And in year 4, we recover it. So the $2,000 at the end of the 4th year are a cash inflow for us. So notice that there are 2 amounts of money spent in year 0. So it gives us a total of $102,000. And in the 4th year, we have a lot of things going on. There are 3 sources of money for us. First, the operating cash flow, or the profit we make from selling pizzas. Then we have the after-tax salvage value, the money we collect when we sell all equipment that we will no longer need. And the 3rd source of our money is the cash that will be recovered from the project. Okay, so we have our project total cash flows. So year 0, negative 102,000. Year 1, 79,400. Year 2, $109,880. Year 3, 131,928. In year 4, it's the sum of 155,710, 25,682, and $2,000, which combined give a total project cash flow equal to $183,392. What do we do with them? We find the net present value using 10% as the discount rate, which was given. The easiest way would be to use the cash flow case in the financial calculator, where negative 102,000 would be your cash flow 0, and then the other 4 cash flows will be entered as cash flow 01, cash flow 02, cash flow 03, and cash flow 04. Then you press the NPV button. It asks you to enter the interest rate, I equals, you put 10, save it, and then press compute. What do we get? $285,370.40. Now, last step, evaluate. Well, because the net present value is above $0, the project should be accepted. It's a good project. What we get back in the future, over the future 4 years, years 1, 2, 3, and 4, is greater than $102,000 that would be invested today. So the money that would go in is less than the money that would come back to us, which makes it a great project. Let's look at one more numerical example on capital budgeting. This one is known as a cost-cutting proposal. There is less information given, which makes it a lot easier to solve, but there is one twist to this problem. So let's see what's given to us. Ralph's is considering buying a new cutting-edge cash register that will initially cost $1 million. It will save Ralph's $400 a year. The cash register is expected to last 5 years, after which it is expected to sell for $100,000. It will be depreciated using 3-year makers. There is no impact on net working capital. The tax rate is 34% and the required rate of return is 8%. What is the NPV of this project? Okay, there is not that much information going on. Everything is relevant. There is no such thing as sunk cost that's already occurred in the past, or anything related to loans. So everything here is relevant for the NPV calculations. Let's put everything that we are going to be working with on just one slide. Just like in the previous problem on pizza production, we would want to start with revenue calculation for each year, then the production cost calculation. However, if you go back to what's given, you will see that it says it will save Ralph's $400,000 a year. So where does this saving amount fit into our NPV problem? Is it $400,000 in additional revenues, or are we going to be spending $400,000 less on production costs? It's unclear, right? It could be actually one of the two, or it could be a combination of an increased revenue and decreased costs. So savings is like the difference between additional revenue and additional cost, right? So kind of the net, the difference between the revenue and the cost. Okay, so for every year, we can put $400,000. Years 1, 2, 3, 4, and 5, right? Then where would these savings fit in? Well, remember in the earlier problem, we had to use revenue and cost as part of the operating cash flow formula. The one, one of the 4 versions of it called the depreciation tax shield approach. And that formula had revenue minus cost in the parentheses up front. Now that's replaced with savings, $400,000. We're also missing the depreciation amount, and just like in the previous problem on the pizza sales, we are gonna have to calculate the depreciation amount 1 year at a time by multiplying the purchase price of the cash register, which is $1 million, by the maker's percentage for that year. And now we are looking up the table for the 3-year property class, which was given. For that property class, we will have 33.3% for year 1, 44.4% for year 2, 14.8% for year 3, and 7.4% for year 4. This is the end of the economic life of a 3-year property class asset. And so for the 5th year, you can put 0% because all value has already been lost. When you multiply these percentages by $1 million, you get the depreciation for each year. And when you then put these numbers together with the $400,000 savings into the OCF formula, you get for year 1, $377,220, for year 2, $414,960, for year 3, $314,320, for year 4, $289,160, and for year 5, $264,000. Okay, we're done with the operating cash flow for each year. We need 2 more things, and then we combine the 3, and that becomes our project cash flow for each year. So the 2 items which need to be computed next are the net capital spending and the change in net working capital. So what do we know about the net capital spending? As always, it's going to be 1 year for year 0, and 1 number for year 0, and 1 number for the final year. Year 0, that's the initial investment, and it's given a $1 million cost of buying the cash register. For the 5th year, as always, it needs to be the after-tax salvage value. So the money we get to put in our pocket when we sell the cash register used. And from the earlier slides where I explained the after-tax salvage value formula, you can use either one of the 2 versions of the formula. It's not going to matter. Mathematically, they both give the same numerical answer. So here the version I'm using is take the sales price, that was $100,000, it's given in the problem, minus the tax rate of 34% multiplied by the difference between the selling price of $100,000 and the remaining book value. I put $0 for the remaining book value because the last depreciation rate was for year 4. So that after the 4th year, the full value of this cash register, the full 100% of its value is, lost. After that, it's, worthless in the accounting sense, right? So after the 4th year, the remaining book value was already $0. After the 5th year, it's still $0. So you just put 0 in the formula. Or technically, you can completely skip it. Okay, so $66,000 is what you get for the after-tax salvage value at the end of the 5th year. Next, change in net working capital. In this problem, we have no impact on the net working capital, which makes everything easier. It's just, a blank row, right? $0 throughout. Then for each year, you add up the operating cash flow, the net capital spending, and we have nothing going on for the change in net working capital. So the project cash flow for year 0 is simply the purchase price, negative $1 million, which is spent. For year 1, it's the operating cash flow, $377,220. For year 2, 3, and 4, it's again the operating cash flow that we calculated earlier. And for the 5th year, it's a combination of two numbers, the operating cash flow of $264,000 and the after-tax salvage value that we receive from selling the cash register used, equal to $66,000. When we combine the two, we get $330,000. What do we do with these cash flows? We discount them and we find the net present value. So we discount them using the 8% discount rate. It's much easier to do it in the financial calculator using the so-called cash flow case, where minus $1 million is your cash flow 0, and then the total cash flows for years 1 through 5 are your cash flow 01, cash flow 02, cash flow 03, cash flow 04, cash flow 05. Then you press the NPV button. It asks you for the discount rate. You press 8. Save it by pressing enter, and then you press compute. The answer is $391,690.10. Just like in the previous problem, this answer is positive. The net present value is above $0, so the project should be accepted, which means we should, or Ralph's should buy this cutting-edge cash register because it's going to be, a profitable investment. Let's summarize chapter 10. First, we looked at how we determine if cash flows are relevant or irrelevant to the capital budgeting decision. Everything is relevant except for two things. The first thing that's irrelevant is a so-called sunk cost. You can simply think about the timing. If it's something that has already been paid in the past, before the decision on the project, accept or reject, is made, then it's irrelevant. The second example of an irrelevant cash flow is a so-called financing cost. That's anything related to a loan, like making loan payments. We treat them as irrelevant because they're not operating expenses. You can also say that they are kind of optional. Also, something we're going to see in later chapters is any loan is typically reflected in the discount rate. What are the three components of the total cash flow for each year? That's the operating cash flow, the net capital spending, and the change in net working capital. What is operating cash flow? It's pretty much the same thing as profit from selling whatever it is that we would be selling under this project. So this is similar to what accountants calculate in an income statement, the bottom line, net income, except in finance we also add depreciation back to it, and that's how we find the operating cash flow, because depreciation is not a true expense. So we add it back to net income in order to correctly calculate the profit made for that year. What does net capital spending include? Typically, it's initial investment that we find for year 0, and that's usually given, and the after-tax salvage value that we find for the final year of our project. So that's the sale proceeds. What is the difference between net working capital and the change in net working capital? And which one do we include in total cash flow for each year? Net working capital is like things like cash that's set aside to cover any unforeseen expenses related to the future project. It also includes things like inventory, accounts payable, accounts receivable. However, it's the change in net working capital that we are interested in, because this is what reflects the incremental cash flow, the additional investment towards the project.